Welcome to the second episode of my 5-week trading bootcamp, a free crash course for those who truly want to master trading in the best and simplest way possible. And if you are thinking, who am I to teach you? My name is Sam, but you can call me ATP, and I have dedicated myself to mastering this market. I have studied extensively, including completing certifications at Oxford and other respectable institutions, and so I believe that I may have the tools and knowledge to simplify complex trading concepts and help new traders to succeed. In the first episode, I laid down the basic principles of trading, defined key concepts, shared tips on backtesting, and started creating a new indicator-based strategy from scratch, exploring the process of selecting an entry trigger indicator. Today, I will dive deeper into the risk management system, showing you how to get the most profit out of each trade, and I will also select the second piece of my trading system, the exit indicator. If you are new here, subscribe and get ready, because this is where our trading success begins. Similar to the first episode, I will start the second one by exposing another trading myth, this time being the best take-profit method is the 1 to 1.5 risk-reward ratio. Despite this method's popularity, popular doesn't always mean best. Let's understand why. Markets are not static. Every day they have different levels of volatility, which directly affect price movements. When volatility is high, market price can have significant movements. Conversely, during low volatility periods, price movements may be lower. Therefore, sticking to a fixed risk-reward ratio of 1 to 1.5 as the supposed optimal approach for maximizing trading profitability overlooks the dynamic nature of markets. In volatile conditions, this take profit may be too restrictive, cutting potential gains. In the same way, in less volatile conditions, the same level could be too large, leading to long exposure periods and increased brokerage costs, something no trader desires. So, the statement that a fixed 1 to 1.5 risk-reward is universally superior is fake. The key to taking profits lies in adapting our levels to market conditions. Just as a surfer rides the waves dictated by the ocean's current, smart traders must take profits according to what the market has to offer. And don't worry, this does not involve any complex methods. Throughout this episode, I will teach you how to do exactly that and demonstrate with proven results why adaptable take profits outperform a 1 to 1.5 fixed take profit. Before we dive in, I will just recap where we stand with my new strategy for the 1-hour time frame for trading forex, crypto and metals. Our current setup includes the C1 indicator stochastic with settings 12, 18 and 11, which proved to be the most consistent choice after testing 100 different options. For more details, be sure to catch the first episode of my bootcamp. As discussed in that video, setting stop losses for trades signaled by the stochastic involves using the ATR bands indicator with a multiplier of 2. This indicator places the stop loss levels directly on your chart, red lines for long positions and green ones for short positions. The advantage of using the ATR in calculating stop losses is that it adjusts them according to the market volatility, confirming that our stop losses are always placed on the optimal level. Now, regarding take profits, I mentioned in the first episode using a static level of 1 to 1. Only for win rate and other metrics calculation. However, this won't be my only take profit level. To maximize each trade's potential, we'll employ 2 take profit levels. So, the static one at the 1 to 1 risk-reward zone, which will be used only to close 50% of our positions and to protect the trades by moving the stop loss to the entry point. The profits from this partial close help cover commissions and losses from losing trades, with the real profit coming from the second half of the position by using a trailing stop loss. This dynamic risk management tool protects profits while allowing for further gains. Unlike a fixed stop loss which remains fixed at a specific level, a trailing stop loss adjusts its level as the market moves in favor of the trade. And it is going to be very simple to insert it, because we will also use the ATR bands indicator to establish where to place our trailing stop loss. For long positions, after hitting our initial 1-to-1 take profit and closing 50% of the position, we will move the stop loss to the entry point. Then, whenever a new candle closes at new highs, we will adjust our stop loss according to the red line of the ATR bands indicator. And we only move the stop loss when new candles close at new highs. Likewise, for short positions, after hitting our initial 1-to-1 take profit and closing 50% of the position, we will move the stop loss to the entry point. Then, whenever a new candle closes at new lows, we will adjust our stop loss according to the green line of the ATR bands indicator. And again, we only move the stop loss when new candles close at new lows. In both directions, the remaining 50% of the trade will be closed automatically when the price touches the trailing stop loss. There is no need for manual closure. This approach allows us to exit quickly during periods of low market movements and maximize profits during volatile periods, which often leads to significantly higher profits when compared to fixed take profit methods. So, this method represents the optimal way to steady profits, protecting our initial position and then scaling our profits according to what the market has to offer. Before we proceed further, let's conduct a brief case study to confirm why the myth surrounding the 1 to 1.5 risk-reward ratio is indeed fake. So, I will perform 2 tests on one of my chosen assets from the previous episode, gold. First, I will conduct a backtest on my in-sample data from 2022 using the signals from the dollar stochastic and the fixed take profit set at the 1 to 1.5 risk-reward zone. Then I will conduct a second test under the same conditions, but this time using the trailing stop loss, and we will analyze what happens. Although I could perform this backtesting manually, as I showed you in the first episode, I prefer to accelerate the process using my indicators testing bot. This tool allows me to customize data samples, risk management settings, and select indicators for testing. I can even define the trading sessions according to my available time to trade. Within seconds, I can view all the trades marked on the chart, along with their respective stop losses, take profits, and even trailing stop losses when applied, and analyze the monthly results here or the overall ones on the Strategy Tester tab. But, as I said, you can perform the same process manually. The difference is that in that case, it is going to be more time consuming. For the first backtest, I will set the data sample to start and end in 2022. In the risk management section, I will use a stop loss based on 2 times the ATR PP value, corresponding to the ATR bands lines on my chart, and a fixed take profit constant of 3. Equivalent to a 1 to 1.5 risk-reward ratio. Under the exit condition, I will select the 1 TP option. The 2 TPs option applies to my trailing stop loss method. Then, after confirming that I have defined the dollar stochastic as my C1 indicator with settings of 12, 18 and 11, I will click on OK, and the trading bot will conduct the backtest. As you can see, all trades meet the defined criteria with a take profit set at the 1 to 1.5 zone. Looking at the results in the Strategy Tester tab, we got a net profit of 28.07% after 592 trades, with a win rate of 41.22% and a max drawdown of 22.11%. Now let's proceed with the second backtest, keeping all the conditions identical except for the take profit settings. I will set the initial take profit to a constant of 2, placing it at the 1 to 1 risk-reward zone. Use a trailing stop loss multiple of 2 to be equal to the ATR bands indicator levels, and select the 2 TPs option with a partial profit of 0.5, indicating that the bot will close 50% of the position at the 1 to 1 take profit level and then apply the trailing stop loss to the other 50%. Upon clicking on OK, we can see that all trades meet the criteria, and the trailing stop loss is activated after the 1 to 1 level is hit. By checking the results in the Strategy Tester tab, we see a net profit of 37.81% after the same 592 trades, with a win rate of 45.27% and a max drawdown of 13.22%. And so, these results demonstrate that not only is the net profit higher using the trailing stop loss method, but the win rate has also improved while the max drawdown has decreased. Furthermore, if we repeat the same two backtests, but this time with data from my out-of sample 2023, we find similar outcomes. My trailing stop-loss method outperforms the fixed 1 to 1.5 take-profit approach. Here is the proof based on real and verified results. However, if you continue to have doubts or have other ideas, feel free to share them in my free Discord community, where we will certainly discuss them with you. Additionally, if you would like to use this indicators testing bot to accelerate your backtesting, it is available for everyone. In addition to me, dozens of traders also use this exceptional tool, and the feedback has been amazing. Some of them have even managed to gain access to funded prop firm accounts by using it. Check out the description and this link for more information about it. Having now addressed the risk management aspect related to take profits and proving its effectiveness, let's discuss the second indicator that will be part of our system, the exit indicator. Similar to the C1, the exit indicator is also a trend or momentum indicator, but should react more quickly to changes in the market when compared to the C1 indicator. Its main purpose is to tell us when we should exit a position before the stop loss is hit. This is crucial because currently our losing positions result in full losses, and we can change that. For example, if I had a faster indicator that alerted me here, I could exit this position with a much smaller loss than what I eventually experienced. And by transforming total losses into smaller ones, I can achieve more long-term profitability. In summary, an exit indicator will be used only to inform us when to exit a trade earlier than expected, whether in situations of loss or profit. It is a trend or momentum indicator and should react more quickly than our C1 indicator. Another helpful tip I would like to share is that if your C1 indicator is a trend indicator, then prioritize using an exit indicator based on momentum. And the opposite is true, to enhance the diversity of your strategy. In my case, since the dollar stochastic is a momentum indicator, I will search for trend indicators for my exit function. And to discover which exit indicator is the best for our strategy, we will apply the same process we used to discover our C1 indicator. Test several different indicators with this function under the same conditions, compare the results and select the most effective one, using both in-sample and out-of-sample data. If you have any questions about this process, refer back to episode 1 where I explained everything in detail. Now I will begin testing indicators with this exit function, again with my indicators testing bot. This tool not only allows me to select the C1 indicator, but also enables me to choose which exit indicator I want to use. For example, I have currently selected the dollar stochastic as the entry trigger indicator, which means trades are opened whenever new signals appear and are closed at the respective stop loss or take profit levels. However, let's say I want to test the popular parabolic SAR indicator with an exit function. To do this, all I need to do is select the indicator here and check this box to activate the exit function. Then I can adjust its settings below and click on OK. The bot will update everything, insert the parabolic SAR on the charts, and now it will also exit positions based on this exit indicator. For this long position, the exit will happen here, as the parabolic SAR dots moved from below to above the price. The same principle applies to any other of these indicators. Currently, there are 50 indicators available for use, and new ones are added every week. So I will conduct the in-sample backtest in the same way as in episode 1, noting the values of net profit loss, number of trades, which will always be the same because the entry points don't change, win rate and max drawdown, provided by the strategy tester tab. I will accelerate the backtesting process and show you some clips of it, but you have the option to adjust the speed in the YouTube settings to see how the bot operates. I will see you again once I have completed all the in-sample backtests. After analyzing 90 possibilities with different indicators and settings, I've compiled them all into this table to have the final results organized. I also want to mention that in terms of the number of positions open, it's effectively the same as last episode, 1654. The number appears doubled because the bot opens 2 positions with half the risk in each trade, aiming to close one at the take profit level and the other at the trailing stop loss. Therefore, don't be surprised by the number of trades, it remains the same, equivalent to 1654 analyzed signals. Besides the 4 different statistics I took note from the Strategy Tester tab on TradingView, I also recalculated the return over max drawdown ratio. As you can see, most of the results were not very promising, but we should never give up and test as many possibilities as we can. In the middle of many, we'll always find some that stand out, as you can see. But before I reveal the 3 indicators that will advance to the hour of sample testing, I want to clarify that you shouldn't be alarmed by the decrease in the win rate. This is normal. Sometimes trades that will be profitable after some days may be closed earlier at the entry point or with a slight loss due to the exit indicator, which of course will lower the win rate, but this is not a problem. As I mentioned, the exit indicator's job is only to help us achieve more net profit and close trades at the best possible time. The next 2 indicators we will study in the upcoming episodes will increase the win rate. So trust in the process and never doubt the results, because at this point the strategy is only halfway done. So let's not jump to conclusions too soon. By ordering the results using the return over max drawdown ratio, the indicators that performed best in my in-sample data were the half trend with settings 3 and 2, followed by the Arun with the default settings, and in third place the parabolic SAR with these settings. I will not use the other combinations of the half trend and the Arun because I want to test 3 different indicators in the hour of sample phase. So now, to confirm the effectiveness of these top 3 exit indicators and to discover which one is more consistent, I will apply them with the same risk management and across the same 5 assets, but this time to my hour of sample data, which in my case is 2023. To do this, I simply need to adjust the data sample in my trading bot here and rerun the backtest for these 3 indicators, which will be very quick with the help of my trading bot. In the meantime, I would like to present you XTB, the broker I use for trading in my personal accounts and investment portfolios. The great advantage of XTB is that it allows you to trade without commissions and with almost zero spreads, making it one of the top brokers nowadays. XTB has another major advantage as well. By using its app, XStation 5, you can calculate your lot sizes in a very simple way. Because, as you are seeing, by inserting the entry points and stop losses, you can see exactly how much you are risking in that trade, in round numbers and in percentage. And so you can increase or decrease the lot size according to your risk profile, and you will always know exactly what is at risk. XTB does all of that work for you, so don't miss out. To create an account, you can use the link in the description to support me. After applying the 3 exit indicators to my hour of sample data, let's take a look at the results. To compare them with their performance in the in-sample data, I created again another Excel sheet with the percentage differences for each statistic using this simple formula. We can already observe a significant difference from the previous episode to this one. The gap between the samples has decreased, which demonstrates that the strategy with this implemented risk management and exit indicator has improved its consistency and robustness. This progress indicates that we are on the right track. Upon analyzing the difference in the return over max drawdown ratio between the 2 samples, we can see that the indicator with the smallest difference is the Arun with the default setting, which is 14. The net profit for 2023 has increased when compared to the previous episode. It was at 96% and now is at 120%. And overall, the other statistics show minor differences among them. Therefore, I have decided that the Arun indicator will be my exit indicator moving forward. For those who don't know, the Arun indicator is a trading tool used to identify trends in the market. It consists of 2 lines, the Arun up, the orange line, and the Arun down, the blue one. The run up measures the strength of an uptrend by indicating how long it has been since the highest price within a specified period appeared. And conversely, the run down measures the strength of a downtrend by indicating how long it has been since the lowest price within a specified period happened. For my strategy, when the run up crosses above the run down, I will exit from short positions, and when the run down crosses above the run up, I will exit from long positions. And that concludes our second episode of this trading bootcamp, where I have shared the best risk management technique you can use with proven results and selected the exit indicator for my new 1 hour strategy, the run indicator. However, there are still 3 important episodes that you must watch, because they will complement each other even more. On the next one, you will discover one simple way to increase the win rate of your system. So don't miss out. Subscribe and hit the like button to show me your support. Thank you, and I see you in the next week. Bye bye.